Welcome to The Explainer. Today, we are cracking the code on stock analysis. We're going to build an investor's toolkit, filling it with the same powerful, systematic scores that the pros use to slice right through all the market noise.
Think about it. As an investor, you're just swimming in a sea of information, right? You've got news, talking heads, endless data points. It's overwhelming. So how in the world do you find that one great stock? How do you make a choice you can actually feel good about?
Well, what if you had a cheat sheet? A kind of secret code? Because for decades, that's basically what financial pros have been using. They use scoring models that take mountains of company data and boil it all down to a single, powerful number. A number that can tell you a whole story. So let's go ahead and crack that first code.
First things first, before you even think about putting money into a company, you have to ask the most important question of all. Is this company actually built to last? Or is it teetering on the edge? You know, it's like a basic health checkup. So our first tool for this health check is the Altman Z-score. And this one's a classic developed way back in 1968. Its job is super specific and honestly pretty brutal. It predicts whether a company is likely to go bankrupt. It's the ultimate corporate stress test. And the best part? It's incredibly simple to read. Think of it like a traffic light. If the score is above 2.99, you're in the safe zone, green light. But if it's below 1.81, that's the distress zone. That's a huge red flag. And anything in between, that's the gray zone, a yellow light telling you to proceed with extreme caution. It's your first fast filter. And don't just write this off as some old school formula. The original model was a staggering 72% accurate at calling out companies that would fail 2 years later. It even started flashing warning signs across the board right before the 2008 financial crisis. This thing has a serious track record.
Okay, but what if a company isn't in danger of failing? How can you tell if an already decent business is actually getting stronger? For that, we pull another tool out of the kit, the Piotroski Score. It's a simple 9-point checklist to measure a company's real financial strength. What makes the F-score so darn useful is how it breaks things down. It's looking at 3 key things. 1, profitability. Is the company actually making money? 2, leverage. Is its debt under control? And 3, efficiency. Is the core business running better this year than it did last year? For every yes, it gets a point. A score of 8 or 9, that tells you you're looking at a really solid operation. All right, so you've found a company that's financially sound. It's going to survive. That's great. But now comes the next big question for any investor. Is the stock a good deal? Is it on sale right now? This is where we shift gears from just checking for survival to hunting for value. Now, investors kind of fall into 2 main camps. You've got your value investors who are like bargain hunters. They're trying to find an amazing company that the market is just overlooking. And then you have your growth investors. They're more like talent scouts, looking for the next big thing that's ready to just explode. Let's grab a tool for the bargain hunter first. And for that, we have to go to the legend himself, Benjamin Graham, the guy who literally wrote the book on value investing. He came up with a formula to get a rough idea of a stock's intrinsic value, basically what it's really worth, not just what the market is saying it's worth today.
Now, I know what you're thinking. You see a formula like this and your eyes might glaze over. It uses things like earnings per share and book value. But look, you don't need to be a math genius here. The formula is just the engine. It's the number that pops out at the end that we really care about.
And here's the golden rule. The only thing you really need to remember. If the stock's current price is trading below that Graham number, ding, 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 the stock might be on sale. It's a huge flashing neon sign for a value investor that says, hey, look over here. You might have just found a real bargain. But what if you're not a bargain hunter? What if you're that talent scout? You're not looking for what's cheap today. You're looking for the superstar of tomorrow. So let's flip the coin and talk about how you spot a company with game-changing growth potential. For this job, we use Mohan Ram's G-score. It's another scoring system, this one with 8 points, and it's built specifically for growth stocks. Its main purpose is to help you tell the difference between companies with real, sustainable growth and the ones that are just, well, overhyped falling stars that are going to burn out. The G-score gives out points based on 3 big ideas.
It looks at profitability, sure, but it also checks if that growth is actually stable. And, this is so important, it digs into the accounting quality to make sure the numbers are real and not just some fantasy cooked up by a clever accountant.
Reading this score is super simple. A high score, like a 6, 7, or 8, suggests you might be looking at a truly sustainable growth company. A really low score, like a 0 to 2, that's a warning sign for a potential falling star. It's a way to bring some serious discipline to the hunt for growth.
So there you have it. We've looked at a company's health, its potential value, and its growth prospects. We've started to fill out your investor toolkit. And just like any other toolkit, the real secret is knowing which tool to pull out for the right job.
But let's be crystal clear about one thing. None of these scores is a magic crystal ball. They won't tell you the future, guaranteed. A much better way to think of them is like a set of lenses. Each score lets you look at a company from a completely different but totally critical angle. They're the start of your research, not the end. And you know what? The tools we've talked about are just scratching the surface. Your toolkit can get way bigger. There's the magic formula, the Can Slim score. There's even one called the Beanish M score that's designed to sniff out accounting fraud. The point is, this world of systematic investing is massive and incredibly powerful.
So what's the big takeaway here? What's your path forward? It's really a simple 4-step process. 1, figure out what you're asking. Is it about survival, value, or growth? 2, pick the right score for that question. 3, get the data, it's all public. And 4, the most important step, use that score to start asking better questions and begin your investigation.
Because that's what this is all about. These scores, they give you the numbers, they give you the hard facts, an amazing head start. But the real magic of investing happens when you use those numbers to uncover the story behind the business. So the only question left is, are you ready to uncover it?